Welcome to the Q1 earnings call of Federal Bank. With me are Shyam Srinivasan, MD and CEO, Ashutosh Kajuria, ED and CFO, Ganesh Shankaran, Executive Director, Sumit Qtr, Chief Credit Officer, and other executives. Over to Shyam.
Good afternoon, good evening, and thank you all for joining. This call is post our results declaration earlier today. The key messages, like always, I'll share the key messages and, of course, then be open for questions and clarifications. Investor deck has been posted, our details have been sent out, but let me just share some of the highlights. Our operating momentum that has been continuously improving was strengthened this quarter, visible across many parameters. Most importantly, operating profit for the first time crossed 600 crores. And the credit growth that has seen meaningful growth for 9-10 quarters continued to be robust. And even more importantly, it was fairly widespread across both products and geographies. That momentum will continue, seeing us gain share. We are now well north of 1% or 1.07%. On deposits, particularly the granular nature of the deposit profile and the retail nature of the deposit profile, was strengthened even further. 96% of our deposits is now retail. And in this quarter, after shedding a sizable part of our CD book, deposit growth also matched credit growth. So, on balance, the operating performance was strong and will continue to be along the same lines. On the credit portfolio, we had said that the credit costs for FY19 will be around 65 to 70 basis points, and that momentum or that commitment still holds, and Q1 reflects the same number. In terms of the sort of franchise strengthening, the verticalization of the businesses, getting in more sharp focus and talent into the bank, that momentum continues. We've introduced some more senior people into the team to strengthen specific areas which are prospective focus, be it retail and in particular retail unsecured, or areas of government business, fee income, or some of the newer initiatives around vehicle financing. So the quarter is along the direction that we chose to do. CASA continues to grow. We are at 33.47 and the marginal uptick from the previous quarter. Some of the key events for the quarter: one, the FedFina, our subsidiary, has got a strategic partner. We're waiting for the final clearance from the regulator. That should be coming in a few days. So FedFina will step in as a strategic partner True North will step in as a strategic partner in FedFina. Two, we had mentioned in the last call, there is a active effort in one of our subsidiaries, a joint venture initiatives of IDBI Federal. That I don't have much to share as an input because one of the key partner in this relationship has seen some change in their text. So we will know more outcomes as the quarter, as in Q2 proceeds. So beyond that, the investments in Equirus is beginning to take shape. We are seeing some good traction on that count, and a few other initiatives of the bank are beginning to sort of play out. And we are mindful that Q2 should continue this kind of momentum as we sort of strengthen our operating performance. So without getting into too many numbers, I'm sure that will be the focus of the questions for most of you. I'm happy between me and the senior team to clarify and answer questions. So I'm not getting into any further detail. I could read out some of the script, but that's there for everybody to see. Operating profit of 603 crores, net profit of 262.71 crores. Overall business grew 19.5%. Net interest income grew 22.4%, matching credit growth. And deposits, I pointed out, grew 16% after shedding some bulk deposits. So overall, momentum is strong. Credit cost is on guidance. So I'm happy to take questions. Operator, you could open for questions. The entire senior team is here.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. The first question is from the line of Nagaraj Chandrasekhar from Laburnum Capital. Please go ahead.
Thank you for taking my question. On slippages, given your guidance in the last con call on 1100 to 1200 crores in slippages for the year and the 460 crore amount we've seen this quarter, are you projecting a significant fall in slippages in the next 3 quarters to sort of meet this guidance?
Yes.
And secondly, how much more of the restructured book do you expect to slip into NPAs and in what period would that happen? Thank you.
Thank you. The restructured standard book as we speak is about 555 crores. One large account of 250 odd crores. And the rest is a granular bunch of accounts. So we are guided between 1100 and 1200 crores of slippages and 65 to 70 basis points of credit cost. Both of that look quite possible. This quarter of the 207 crores of the corporate, 163 crores was the restructured standard. So the 461 has 207 crores on account of the corporate slippage. The rest is about 250 crores. And therefore we think as in the quarters ahead, another 800 to 850 crores will be the slippages, which should be split in the same ratio as I mentioned, ex-corporate. Corporate we don't see many significant slippage. Excluding Air India. Air India is the only white card, which I've been saying for many quarters. I think there is a solution that may come through.
And on provision coverage, this has dipped slightly relative to the last quarter. How really is this likely to evolve and over what period should you sort of get it to above 60% if that is your sort of ballpark long-term figure you want to be at?
We are sort of certainly keen to build back provisions, but I must be honest, it was not going to be in 1 or 2 quarters. We will, we are and we are hopeful that there can be one-off gains which can be the ballast we'll look for. But we will keep pushing this up because as the credit quality or the slippages keep trending down, the provision coverage will go up as we keep adding up some of the provisions and not entirely take it into P&L.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah, congratulations. Good set of numbers. The other thing was in terms of security receipts. So how has been the provisioning during the quarter on SRs?
It was 180 crores as at the end of 31st March. Now it is 183 crores provision part.
So as of now, there is nothing which has been done during this quarter. And I think in terms of what we earlier guided that there could be 75 to 80 crores which would get provided on SR over a period. So that stance still continues or we had seen the improvement over there?
See, if you see the gross value from 725 crores, it has already come down to
480.
479 plus 183. About 660 crores. So from 745, it has already come down. 725, it has already come down to about 660 crores. And provision is 183.
So 469.
So net of it is 479.
Okay. No, so in terms of the further provisioning, how are we looking at it? So that will be...
Further provisioning, as usual, every quarter we take the NAV, so accordingly, if there is any, revision in that, it would be taken care of, but we have been, even getting some of the redemptions done and all. So, in one major account, we have got a, full redemption. So it got security receipt has got fully redeemed and all. So I think it's something which is quite fluid, and over the quarters we'll see how this outcome of the NCLT things and all shapes up. And if we get more payments, then I think there would be less provisioning requirement and there would be more of redemption.
I think that's why the overall guidance of 65 to 70 basis points on credit cost covers for all of this.
Okay. And the other thing is in terms of the improvement in the slippage run rate for SME segment. So anything specific to read into it because the run rate is quite outflow and looking at the way the overall slippage run rate is, how would be the growth prospects in the SME segment?
Already said that.
Sorry,
Run rate of slippage.
No, the question was, how will be the growth or how will be the slippage in the SME?
No, so slippage is, it's comforting. It's on a decline. So in terms of the growth outlook and the confidence in the SME segment for us?
I think we remain confident in the SME segment. In certain geographies, consciously we are de-emphasizing. As you will see in our deck, in the Network 1, as we call it in Kerala, there are some challenges temporarily, so we are scaling back or cutting off some segments which are riskier. But pan-India, we remain optimistic, and our growth is about 25-26%. That will continue.
Okay. And lastly, in terms of recoveries and upgrades, is there any chunkier account in this 246 crores?
We had one upgrade, one account of significant upgrade.
Okay. Okay. Thank you.
Thank you. The next question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on great set of numbers. Sir, couple of questions. One on the margin side. So in media, you highlighted that our NIM should sustain around 3.2. So what should drive this little expansion, considering limited scope for the further expansion in CD ratio? At the same time, pressure on asset yield, and there might be increase in cost of deposit also. So what should, drive this little expansion or should help us in sustaining the NIM at current level?
I think the media where I spoke, I said it's just not pricing power. It's a combination of things. As slippages trend down, your reversal of interest income is a meaningful reduction. Then the better utilization of the assets and the asset mix yield. There are new areas of business that we are foraying into. So the expansion or a full year guidance of 3.2 visualizes all of this.
Okay, sir. So secondly, on our corporate rating profile, so this quarter we saw a sharp increase in below BBB rated book to 16% from 9% in previous quarter. So I'm sure we must not be lending to any risky corporate, but why this sudden increase in the...
No, I think it's because every year in the beginning of the year we re-listen. This year in wholesale assets we have added commercial banking and corporate. So earlier we were only reporting corporate.
Okay. So this is because of some part of SME now is classified under corporate.
Yes.
Okay.
I think we've said that at the bottom. If you see, includes all rated corporate and commercial banking assets.
Commercial banking is between 5 to 25.
Okay. I might have missed that note. Okay, sir. Sir, can I ask a last question?
If others allow you.
Go ahead.
Yeah, sir. Just a small question on the cost thing. So, so despite absorbing the full impact of the gratuity-related expense, our cost to income has actually declined by, 100 basis points sequentially. So what, it should trend downwards going forward, considering there will be no one-off expense on the employee side going forward, so how do you see the cost income moving going ahead?
At the risk of sounding a little defensive, I've always maintained for many quarters, it's less a cost issue, it's more an income issue. As income trajectory moves, one. Second, if the pensioning cost, which is unfortunately a variable that is not entirely in our hand, that's the only wild card. Otherwise, our costs, whether operating costs or employee costs, are pretty much in our grip.
Okay, sir. Yeah, fair enough, sir. Thank you so much, sir.
Thank you. The next question is from the line of Kaushik Poddar from KB Capital Markets. Please go ahead.
Yeah. See, as on 30th June, your total stress book ratio is at 2.01%. Where do you see it on 31st March 2019?
See the mix and that the stressed assets on account of restructured standard is at 588 and the SR book is at about 469 unprovided for. So that's about 1,000 odd crores.
Right.
We believe that should trend down to another 250 to 300 crore reduction on that. And the gross, the net NPA is about 1,620. 1620 should come down to another. So we see that trending down and roughly 1.7 to 1.75 at this juncture.
1.7 to 1.75, right?
Yeah.
Okay. That's it. Thank you.
Thank you.
Thank you. The next question is from the line of Suresh Korada, an individual investor. Please go ahead.
Hello, sir. This quarter, there was a virus scare in Kerala. Did it have any impact on the business? And secondly, the gold loan book has come down to a significant extent. What are the reasons? If you could explain, please.
Sure. Thankfully, no impact or effect on us on any virus scare. And we are constantly reinforcing our cyber security and our cyber alert capability. So I'm reasonably confident we are in decent share. Did you mean cyber or you're talking of Nipah?
Nipah.
Okay. Sorry. My apologies. My mind is tutored to discuss on business. Thankfully, on Nipah scare, the government did a remarkable job of intervening quickly. In fact, the Chief Minister was given some global award in the U.S. for early intervention. That's been nipped quite well, and it's not spread. And it was very localized in one geography in North Kerala, so we haven't seen any impact. Even worse, the last 2 days, the rains are the ones who's worrying us. But coming to your second part of your question on gold loan, gold as a category, you may have all been tracking. Industry level has started trending down. Our retail gold has come off, but our agri gold is going up nicely. So the gold loan book is actually growing, but retail gold is coming off. And that's just a client preference and a client behavior.
Okay, sir. Yeah, thank you.
Thank you. The next question is from the line of Shiv Subramaniam, an investor. Please go ahead.
Sir, good evening, sir.
Good evening.
Sir, actually, my question is regarding that gratuity amount of 54 crores which was absorbed in this quarter. Whether it is fully absorbed, there won't be any further debits during the subsequent quarters, sir?
Yes, it's fully absorbed, sir. It's there in our annual report also. Point number 11 specifically talks about the impact was 54 crores for the full year. We took it in 1 quarter, and therefore the impact for the residual period is not there. Of course, if government makes 20 to 25 lakhs, that can change, but that is unlikely.
Okay, and then this True North proceeds, 26% sales, when it is likely to come into books?
No, it's not proceeds, sir. They are a strategic investor introducing capital into the company. Okay. It's not coming into the bank's P&L. Having said that, we are awaiting RBI approval. That is going through its process. We are hoping that in the course of the quarter, that approval should be in hand.
And there is a reduction of 43 crores in other income. Can you please elaborate on that, sir?
Last year, Q1 Treasury had a remarkable gain because where the yields were. That unfortunately has got reversed, and that's an industry-wide phenomenon.
Okay, fine. Yeah, thank you.
Thank you.
Thank you. The next question is from the line of Rahul Sharma, an individual investor. Please go ahead.
Good evening, sir. Congratulations for a fantastic set of results. Sir, could you give me a breakup of the provision, the 340 crore number? How much of it is on the asset side, the NPAs?
166 crores is credit, 3 crores is standard asset, 30 crores is treasury. 199 crores, baki is tax.
Rest is tax. Got it. So also, what has led to the increase in the net NPA ratio marginally, just trying to get some more granularity?
I think the recovery upgrade and technical write-off was 400. Gross NPA is slippage was 466. So balance is 66 crores. That is provision. Balance goes into net NPA.
Got it. So also going forward, now all the banks are saying that you want to do retail assets, you want to do retailization of the bank, etc. So do we see any NIM pressure going forward in the retail side? And secondly, do we see any stress on mortgages which DCB has seen?
2 parts. One is we have for long and hopefully will continue to say we want to be balanced across segments. We are not biased one or the other. We've noticed our corporate has been going nicely and our business model is effective. So that's growing at 30%. So is our commercial banking catching up. So retail is growing nicely in pockets. Barring 1 or 2 geographies, we are not seeing any stress on the mortgage portfolio.
Got it, sir. Any pressure on the NIMs because of the competitive intensity in the retail?
We are talking of NIMs for a full year roughly 3.2. So it's an upgrade from where we are.
Okay. Yeah, that's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Vidisha from Prabhudas Lilladher. Please go ahead.
Hi, this is Srishankar here. A quick question.
Excuse me, this is the operator. Sir, may we request you to use a handset, please? Your voice is not clear.
Yeah. Is it better?
Yes, thank you.
Yeah. I was just looking at the corporate level. Where exactly in outside Kerala you are seeing the increase in the corporate advances? That's my first question. Second, coming to a retail growth. Are we actually seeing on the retail side ex-gold not being able to grow when you compare it with the fourth quarter?
I don't know. The first part of the question, corporate is growing pan-India. And, of course, by definition, Mumbai being headquarters of all corporates or many corporates, naturally the western region will see the maximum growth. But ours is fairly balanced across the country, so we don't have any geographical bias. And so that's 30-odd% I would say would be spread across the country, and that will be the rate of growth across. Denominators being different in each state. The second part of the question is retail. No, sorry, I didn't get the question on
Sequential growth in retail.
Sequential growth in retail was 3%.
Including gold.
Ex-gold was 4%.
Ex-gold. If I look at, compare it with the Q4 presentation.
Srishankar, typically Q4 is a bulk quarter for anybody across products.
Yeah, so that
usually Q1 is for us been traditionally sub 1%. We are quite pleased that it's been a very robust growth on retail this quarter because the distribution mechanism is very different and that's firing quite well.
Okay. Thank you.
So shall we take the next question?
Please go ahead.
Sure. The next question is from the line of Jai Mundra from BNK Securities. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So first on the margin side, just for arithmetical purpose, arithmetically, our yields have declined by 2 basis points quarter on quarter and cost of deposits have actually decreased by around 12 basis points. Whereas the NIM is slightly, let's say, 1 basis point up. Is it something more than this or, if you can just, because arithmetically margin could have expanded more.
But you're looking at it through the lens of yields only. You have to look at the slippages and the consequence of the reversal on interest.
You have the investments also. Interest comes from various segments. Interest on advances, interest on investments, and other sources.
Sure.
So it's not straight line. This thing that in interest, the yield on advances. Certainly, what you are saying is correct. Exactly like that. Cost of deposits has come down. But you have the income on investments, interest on investments, that also has, flattened or little, it has reduced because we have decided to reduce duration. So when you have lower duration, yield will be lower.
Sure. And sir, in terms of cost of deposits, this quarter, again, it has fallen off. And lately we have seen, there's the cost of deposit has been rising. So what is your sense? When would we start seeing the cost of deposit rising on a blended basis? Or we can still have 1 or 2 more quarters wherein cost of deposit could still fall?
We expect that in the current quarter, it would be either flat or would start reversing from here because the impact of it is only in term deposits. As regards CASA is concerned, we continue to have a savings bank rate of 3.5% and 4%, 3.5% for up to 50 lakhs and beyond that, we pay 4%. And current account would not have, because these are basically the fixed rate deposits. When it comes to term deposit certainly has, the peak rate has gone up, but the impact of that would probably start coming in towards the end of quarter 2 or beginning of quarter 3.
Sure, sir. And just wanted to check the last quarter we had mentioned there was 150 crores of SDR, 525, all these things put together. If we have provided that number as of first quarter?
That 555 crores of standard restructure includes everything.
Yeah, so that included, even for the last quarter, that included everything. Yeah. But just if you have provided what is the, this pool of SDR 525?
I don't have it offhand. Maybe you should check with Raj. I don't have it offhand, sorry.
Sure. And sir, I missed one part. If you, pardon me if you have explained already. Have you provided any, more detail on the reduction or the recovery upgrades which has been coming? Is it more to do with,
246 crores is recovery upgrade and slippage was 461 and technical write-off was 153.
Yeah, so this recovery upgrade, is there something from education loan portfolio that has been recovered or
mixed.
Is it...
Very mixed. There's one large, but outside of that, it's very granular.
Sure, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Bhavik Dave from Reliance Mutual Fund. Please go ahead.
Hello. Hi, sir. Sir, just wanted to understand on your corporate book, can you give us a flavor of how your SMA 0 since the 12th February circular, how is the SMA 0 trending and what are the kind of steps that the consortium takes when an account gets a day overdue? How do you manage those accounts and how is the quantum shaping up in the last 3-4 months?
The SMA overall book is at an all-time low.
Okay.
And while I'm not giving you specific on SMA 0 or SMA 1, our SMA book is at all-time low and it's been trending for many sequential quarters. We are not much into consortiums right now.
Okay.
So most of it is either bilateral lending or names we are very comfortable with. Thankfully, have not got into the SMA category at all.
Whatever on stock we had is getting reflected through the standard restructured, which pool is diminishing. On the flow, we believe that the relevance of this is little less to us, the way we are pursuing our business now.
Correct. And on the incremental lending front also, we are doing more of non-consortium lending, right?
For last 2.5 years, I don't recall doing any consortium.
There's nothing called non-consortium. Every company has its own arrangement. Some prefer bilateral, some prefer multiple banking. There is opportunistic assets. We play along with what the client wants and move along.
Sure. All right. Okay. Thank you, sir.
Thank you. The next question is from the line of Anand Latta from HDFC Mutual Fund. Please go ahead.
Hello, sir. If you can give some color, like what proportion of our loan book are linked to 3-month, 6-month or 12-month MCLR?
MCLR lending of the bank is now 80%?
Close to 80.
Yeah. 70 plus. 70 plus.
70 plus is MCLR lending?
Yes.
And 30% balance should be fixed rate or they are still linked to base rate?
Base rate linked,
base rate,
mixed.
Based, fixed.
Even PLR linked.
Right, different.
Some small amount would be even PLR linked.
Okay. And sir, on the MCLR side, so what proportion will be linked to 1-year MCLR and what proportion could be to a shorter duration MCLR like 3-month or 6-month?
I would say some of the new home loan originations come at a lower 3-month MCLR. And corporate, depending on the client relationship, it would be. So I would say 20% of the new flow.
On the book side, sir? On the
book side, new flow. On the book side would be what?
Less than 10%.
Less than 10%.
So less than 10% is linked to short-term MCLR, like 3 months or 6 months.
Yes.
And bulk of that will be linked to 1-year MCLR.
Yes.
It's only in 2 segments, housing and corporate.
So I didn't got it, sir.
See, they are only in 2 segments of the loan book. One is under retail housing loan, and there is another one under CIV, corporate institutional banking for AAA corporates.
Which is linked to short-term MCLR.
That's right.
Okay. So our exposure to HFCs and NBFC had been rising. So any thought on the same? And sir, is it all HFC and NBFC exposure are linked to 1-year MCLR?
2 parts. One is I don't know where you're saying it's rising. It's been actually trending down. All our NBFCs and HFCs are absolutely blue chip. And therefore we are not seeing any issue. Pricing depends by each client. It's not standard. I can't template it.
And depends on the tenor for this kind of fund.
Yeah, it varies.
Okay. But given that large proportion of our back book is linked to 1-year MCLR and the interest rate in general, the term deposits are trending upward, do you see margin pressure for us in coming quarters, or how do you?
We have guided for 3.2 after factoring all this.
Perfect. And part of the loan book which is linked to an external benchmark?
There are parts.
So those parts will be what, sir? Below MCLR lending rate, sir?
Could vary, yes. They could be below MCLR.
It is all included. We are talking of less than 10%.
They're all not significant for the bank.
Okay, so less than 10% of the loan book could be linked to external benchmark which are below MCLR.
Yes. Or 3 months MCLR.
Okay. And sir, if you can give the breakup of the CASA and
Raj?
5,000.
5 and 28.3. 5% and 28.5. 28.5%.
So if you can just put that in our presentation every time, both the breakup of the provisions and the breakup of the CASA, it will be helpful.
Sure, we will do that. Thanks, we'll do that.
See, total CASA is 33.47, which is given in,
5 and 28.5.
5 and 28.5 is the breakup.
Okay, thank you.
I think it's there in slide 18. Our team tells me it's there on slide 18.
Okay, fine, sir. That's from my side, sir. Thank you.
Thank you.
It's there.
The next question is from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, sir. Could you spell out the NRI current account, savings account, and term deposits separately in absolute numbers for this quarter, and if you have the number handy for March
18, Nilanjan, it's there. Given
can
by...
you split? No. Is it given?
It's the NR savings, NR business, current account by the two networks, both absolute and percentage.
No. The NR business, if you can split between savings and current.
Oh, you want the NR breakup, is it?
Yes, I want only the NR specific, savings and current.
NR current is 200 crores.
NR current is 200 crores, so you could take the remaining as NR savings?
Yeah.
I know, it's
savings and term deposit.
Savings and term.
Could we have the savings?
NR savings is 13,283. Right?
And what was it in the previous quarter, sequential quarter?
12,000, previous sequential is 12,380.
Okay. And any updates on, what's happening on the Middle East because of changes in policy? Have you seen any impact on the flows because of that?
Yeah, the flows have increased.
See, I've maintained in all calls, the NR, in particular Middle East Kerala corridor, invariably benefits when there is either uncertainty or rupee is weaker. And we tap the maximum part of that benefit. The credit behavior is different when there is instability in the Middle East. And consciously we have been increasing the cutoff or being more watchful on the new origination of credit on accounts that are linked to the non-resident borrower. So it has two different behavior, and one is a very magnificent growth in deposits, which is
more than 20%.
We see that continuing, and it's seasoned across 26 years from the Gulf War. And,
right.
And credit book does have bearing every time there is any kind of inconvenience in the Middle East, and therefore we are sort of shaping our book accordingly.
Right. Thanks. The second question is on in the corporate business. Could you tell us, when in the origination part, what part of it would be, working capital versus long-term loans?
65% will be working capital. Right?
Largely 25-80.
Long-term now we are not into long-term.
Short-term.
Just largely short-term.
Okay. So then my credit and business side have said it's even higher than the number I told you.
And long-term is mainly LRD and all.
Mainly LRD. Okay. So how much spread do you actually make? Because I'm just curious, while you have guided for a 3.2%, would that mean a bulk of it is actually coming, or maybe now coming from the commercial banking side and the retail maybe?
Yeah, a combination of the business mix, the growth rates in different businesses, lower slippages, better utilization, growth in the low-cost deposits.
Right. Okay. And a final question. Are you still sticking to a 1% exit ROA?
Yes, we are.
Okay. Thank you.
Thank you. The next question is from the line of Ojasvi Kicha from SBI Cap Securities. Please go ahead.
Yeah, thank you for this opportunity.
Excuse me, this is the operator. Mr. Kicha, may we request you to use the handset, please? Your voice is not very audible.
Yeah, am I audible now?
Yes, it is better. Thank you.
Okay. So as we have, split our SME business, into two different segments. So just wanted to understand how should we look at the economics of commercial banking versus the economics in the CIB segment?
The commercial banking, if you do a sort of hierarchy of margin opportunity, corporate, commercial banking, business banking, that's how it would play out. And consequently, the level of focus, intensity, and approach varies in each of these businesses. One is very heavily RM-led, the other is an RM stroke branch-led, and the third is largely branch-led. And therefore, the structure and the growth rates of these businesses are different, tuned to those opportunities. Margins are I would say 1% higher in each of those steps. 9, 10, 11 kind of thing.
Sure. Secondly, this RBI circular, so the working capital limits, if you could just, provide some qualitative commentary on that.
Does it affect us?
The
large borrower framework, which is saying
working capital demand load, WCDL.
So what's the question? Could you repeat, Kicha?
No, this is specific to, the working capital limits wherein the, higher loan, component need to be provided. So do you see any impact?
Nothing that we are visualizing.
It will help us in our liquidity management because higher the WCDL component, lesser would be the shock on the liquidity side. But suddenly, if you have more of cash credit, one day entire amount would be deposited, the other day entire amount would be drawn. So that reduces. So volatility in liquidity management reduces. So
understand. Okay, that's it.
Good for banks.
Sure.
Mr. Kicha, do you have any further questions?
No, I'm done.
Sure. Thank you. The next question is from the line of Rakesh Kumar from Elara Capital. Please go ahead.
Hello.
Yeah, go ahead.
Yeah, thank you, sir. So firstly, the one thing, the CASA composition, for the last 1 year, it has not grown. So it is, at the same level for the last 1 year. So that is the one question. Second question is that, the retail deposit and CASA, put together, it's a major component of our deposit. And the growth is around 15-16% year on year. But if you look at advances, growth number is much higher at around 24%. So how that is sustainable? And thirdly, this quarter, there has been, good cash management because we see that, the cash balances having come down and then borrowings having come down. And that could have helped us, in some way to manage or to improve margin maybe. So, and how that sustainable is the margin number? These are the three questions I have. Thanks.
So I think on the margin side, NIM already, Shyam has already guided that we continue to say that for this full year we are guiding for 3.2%. So that part, I don't want to repeat it further. On the cash side, yes, special emphasis is being given on reducing the cash in hand and the optimum size of cash and ATMs as well. And we have new chests also, currency chests open, and two are in the, pipeline shortly to be inaugurated. So that way, I think it is helping us in reducing the cash in hand held. Now, coming to your other question of CASA, yes, I think we have that 5% thing has got stuck. But if you see quarter on quarter, there has been a noticeable improvement. From 2011 to 15, consistently, bank had been gaining CASA, around 1.5% to 2% every year. Yes, at 32, 33, it got stagnated. But going forward, That's the project being run internally. So hopefully you would see quarter after quarter improvement in this particular.
There also, I'll point out, the CASA is at 33.47. Unfortunately, the CA, which is 5.6, 5.7, has dropped to 4.8. SA has actually gone up from 27 to 28.5. Like I mentioned in the last call, CA, we have started seeing traction. Second half grew nicely. Q1 usually is slower. Thankfully, the average CA has grown. So we believe that year-end we should be closer to 34, 34.5.
And so one question just I had on the, gaps in the retail deposit, CASA growth and the advances growth.
So that is very clearly, we have to look at deposits always follow the credit growth. So if your credit growth is being funded, that's the, adequacy of deposit to be raised. So I'll just mention here that at the end of financial year 18, we were having 3,000 crores of CDs outstanding. So that was a wholesale type of, resource raising. But we didn't need it. So by the end of June, we are left with only 75 crores. Rest we allowed it to, run down and we didn't reissue. That means the growth in deposit presently is just adequate to fund the, credit growth. In case credit growth further goes up and all that, we have 96% of our deposits being in retail. So at any point in time, we can resort to market instruments like CDs or other, resources, including refinances available from various, institutions, NABARD, EXIM, SIDBI, NHB and all that. So I think what I'm saying is our CD ratio, which used to be 68%, now has moved to 84, and we consider about 86, 87 to be the optimum. And when it touches that, we definitely would be looking at more of resource raising.
Just one last question, if I could ask. Does the rating profile of the wholesale asset seem to have deteriorated?
You maybe missed the earlier question, and also in the slide itself we put at the bottom, I think it includes commercial banking and corporate.
Okay. Thanks.
Thank you.
Thank you. The next question is from the line of Dipanjali Kedia, an individual investor. Please go ahead.
Good evening. Thanks for the opportunity. You mentioned in the call that there has been one large recovery in the education loan book.
No, I didn't say education loan. I said one large recovery.
Sorry. So is the state government scheme still on?
They have a scheme, but unfortunately they keep extending the date.
The scheme is there, the resources are not.
Yeah, but we should not deliberate too much on that because we have sort of neutralized ourselves to that scheme.
We have adequately provided for it.
Sure. Secondly, can you share how much Qtr1 will be investing in FEDERALBNK for the 26% stake?
When the regulatory approval comes, we will declare the amount because we are waiting for that. It's only sensitivity of regulation.
Okay. That's it from my side. Thank you.
Thank you. The next question is from the line of Anirban Sarkar from Motilal Oswal. Please go ahead. Mr. Sarkar, your line is unmuted. Please go ahead with the question. Anirban Sarkar from Motilal Oswal, your line is unmuted. Please unmute the line from your side.
Operator, we can move on because running to another meeting. So if you can take another 2-3 questions, then we can close.
Okay, sure, sir. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good evening, sir. Few easy questions from my end.
I've never known you to ask easy questions.
Sir, on the savings interest part, since you have a distribution which is available from 3.5 to 6.5, where do you see the bulk of your savings book as we speak today? And how much of traction that you're seeing at this 6.5% level, first? Second, you indicated that 1% ROA exit for 4Q. Can you just give us some direction as to how do you see it reaching there, given that the upsides on margin looks limited? How much will have to come from the cost side? And the third question is, there has been speculation on Federal Bank looking at a microfinance business. just trying to broadly understand how are you approaching some of the non-banking pieces that you are now trying to build within the bank, and is it required in the first place?
Yeah, I think three fairly detailed questions.
Easy questions.
The third one on microfinance, I think in November last year we mentioned we are exploring, and we are in July, we are still exploring. We have not zeroed in on any name. We are in dialogue. For three things that we are looking for: one, it gives us increased distribution. It gives us an opportunity to do a relatively higher margin business, provided it's well run and we trust the franchise. And priority sector lending opportunities, and they can turn out to be a BC. We haven't crystallized any final decision with anybody, so I would not venture to give any more detail on that. As we finalize that, if and when, we will certainly clarify. At this juncture, I don't have anything more to offer other than whatever media reports are speculative. One. Two, on the weighted average cost of my savings is still 3.5. The 6.5% is for 50 crores and above, and I think we have two accounts. So if there are more 50 crore and above, we'll be very happy to do that, but that's very, very limited, and that's very, sort of, I would say, almost bespoke. And the third question was confidence on the ROA expansion. We had said, unfortunately it got delayed by a year, we said in the FY18 exit it would be that number, and it's a function of the various elements that we have put in place all working together. In a very crudely, if the exit book is about 145,000 crores to 150,000 crores, for the quarter, the profit number should be that, and we have elements of various things we are doing to get to that number. Be it expansion and margin, be it expansion on NII, fee income, provisioning. And the credit cost guidance of 65 to 70 basis points factors those in.
Sure. The only reason I'm asking is that if assuming that margins doesn't happen, then the entire piece falls on the OPEX line, because credit cost is already at about 70 basis points. Just trying to understand, is there a very strong lever apart from NIMs? Because that's an external variable that we are factoring here.
We don't have anything that is a secret weapon, Mahesh. It's just efficiency and performance and the confidence that we have in what we have put together.
Thanks. And would you give also guidance for next year as we move along during the next few quarters?
I think the credibility of our guidance will be after we deliver on what we have said.
In FY19.
Because we've been seriously punished on occasions for commitments made. So I'd rather performance and the conversation will take off from there.
Perfect, sir. Then thanks.
Thank you. Ladies and gentlemen, due to paucity of time, we will be taking the last question. The question is from the line of Dhaval Gada from Sundaram Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity, sir. Just quickly, two things. What is the blended yield on the corporate book currently, and what is the incremental yield? And similarly for the SME book, if you could provide.
Broadly, 9, 10, 11 is what I had said.
This is the blended?
Yes, 9, 10, 11.
And incremental corporate yield would be?
8.5. 8.5 to 9. There are a few. See, remember, corporate is all not 500 crores. We call anything more than 25 crores as corporate.
Right. Fine, sir. Thanks.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Rajanarayanan for closing comments.
Thank you, everybody, for patiently staying on the call. Thanks a lot. Good evening.